Tim Quast saved the show, apparently.
If there
Good
is
morning,
anyone
sir.
who can save this show from being one of the worst in our history, it's Tim Quast. You need to save this show. We've argued about Bitcoin, roll, and tank.
You argued with everybody, Dennis. I mean,
I'm in an arguing and feisty kind of mood.
You're the fight with
I won't argue with Tim.
I'm going on mute. Fight with Tim.
No,
Joel, I'm going to join
I
you.
love Tim. I won't fight with Tim.
I'm going to join
Me and
Joel
Tim
on
have been
mute.
on the same page for a decade here. So,
That's right. That's
Tim,
right.
Tim, bring us in. I'm just going to mute myself and let Tim talk so we save the show.
Me too.
Well, I'm sorry I didn't catch most of the first half then.
Good. That's a good thing.
Spencer, welcome back. Good to see you. You seem to be well and healthy.
I am feeling good. Thank you. I'm feeling good. Yeah.
Yeah, good.
Yeah. Tim, you know what? Maybe Tim can answer this question. So so Tim, I'm sure you've heard by now that we're going to get a Bitcoin futures ETF this week. We are looking at the different futures contracts, and as is normal with futures contracts, there's some contango. You go out to see, you look at the March, February, trading at a premium to the Novembers and the Octobers, right? As Dennis astutely pointed out, there's no real cost to carry Bitcoin. So why do you suppose the Bitcoin futures market is trading just like the oil futures market and the gold futures market when it's not a physical good
physical oil
that in theory you could take possession of if you were to hold it through expiration?
Well, I suppose you could take possession of Bitcoin too.
Well, that's right.
That's what we're saying. It's easier to take possession. So we see a $2,000 spread in Bitcoin, between the futures and the spot. And I'm like, okay, I'm not a crypto trader. So, I've tried to speculate earlier, but, I was wondering, and maybe you're not a crypto trader either, but I don't know why.
I'm not, but it's interesting. The discussion of derivatives is always informative. And maybe it's just as simple as this, that people don't really understand futures. Particularly this crowd that's trading cryptocurrencies. They don't understand futures, and it's that's concerning. It's concerning that an exchange traded fund, which is a genius idea. We've talked about this before. That they were created by commodity traders, and that's an interesting juxtaposition. ETFs were created by commodity traders from
futures.
State Street.
Right.
Well, they're right. So the idea behind exchange traded funds was, well, wouldn't it be awesome if we could trade the warehouse receipt instead of actually moving stuff in and out of the warehouse? That was the whole idea behind exchange traded funds. So there's they're cousins already, ETFs and futures, but most people don't understand them. Most people don't understand exchange traded funds either. So I think you believe that there's going to be greater demand because of this ETF, and so everybody plows into the futures as far out as they can. I think it's that simple.
Do you know that the futures on the market, you get fully margined? You have to put out the full amount. There's no like 5, 10.
There is no margin. You have to put the full amount.
You have to put the full amount up. So you got to be a player with some big money, even to just trade one contract there, right? So I just want.
I mean, that's the big edge too. That if there was fully margin, you'd say, okay, you don't have to put the full amount up, so you can get exposure to more in that way. But when it's full, that doesn't tell the reason for the $2,000 difference either.
Yeah, right. Well, it's supply and demand to me. That's a nice linkage between market structure edge and these markets. It's all about, that's really what we come back to. It's supply and demand, and the trouble with understanding supply and demand's effect on derivatives is that they're implied demand and implied supply that may or may not actually manifest at the time, and that's what gets confusing. And of course, today new options are trading. So the options that were for October expiration lapsed on Friday and settled Saturday morning. So now there's a new series. that's trading. And all of this stuff comes back to me to supply and demand. I always like to talk about the thing for traders to keep in mind, just so that you're aware, you're prudent, you're well informed. It's good to know what you're doing. That mortgage-backed securities back in 2006 became a way for the residential mortgage market to absorb a lot more demand for the underlying supply. And the trouble with that is when the prices of residential mortgages stopped rising, then all of that implied demand got written to zero. That's always the risk with a derivative instrument. And I've got nothing against ETFs and futures and so on. I just think that you should understand that. And that when prices become uncertain, now we've added an element of magnitude potentially, if this continues on the course that it appears to be on, to the cryptocurrency market by introducing implied supply and demand that can be marked to zero. This is how you increase volatility in markets. On that happy note,
let's go into the markets. Let's go in. Obviously, we can go into some individual stocks. Maybe we should just check out some individual stocks this week. We got Netflix. Let's go to Netflix. We got Netflix going to report tomorrow. Tesla's going to report Wednesday. Let's look at the market structure here. Break down Netflix Tesla for us.
And drum roll, we have officially launched Market Structure Edge 2.0. So
nice.
that will become the platform as of a week from now. And the principal difference is that we've made it very easy to understand supply and demand. That's the whole point here. So everything now will be supply and demand. Noticed on my graph here for the October 18 Benzinga portfolio, where demand is rising and supply is falling, that's what we want to put all the focus on. It's supply and demand and understanding the underlying motivation. This is the challenge for technical charting to me. It's that we don't know what the motivation of the money behind the prices is. It would be good to know that because they don't have the same purpose and time horizon. But we can now just go through here and I can look at everything. If I want to look at Tilray and compare it to STEM, I can immediately see those comparisons and see what the supply demand differences are. So it makes it very quick and easy. So let's go look at Netflix. And Tesla's, again, Tesla has never ceased to be an extraordinary market component. So here's Netflix from a supply demand perspective. So demand has peaked. That's what happens when it begins to come down, but it's still way above 5, and the supply side continues to fall. It was very high. I mean, the reason the price stopped rising right here is because short volume was over 50% and way above trend. So price stopped rising. But this to me says, if you're in Netflix, you could stay in Netflix. The likelihood that this produces a stable stock at least, and maybe a rising one if short volume continues to work its way back below 50% and demand stays above 5. It's just a 10-point scale, folks. And you can go do this yourselves. You can go, if you haven't used Edge, go to Market Structure Edge, sign up for a free trial, put your name and email in, and put Netflix in. You can just look it up just like I did there, and expand the time, and you can go back and see what has happened over time. Netflix has performed well because it spends a lot of time above 5. You own stuff that's above 5 tends to do better. And if we looked at Tilray as a contrast, you had the cannabis show last week, right? So how's cannabis? Well, if we look at this cannabis portfolio over here, mine has 11. You may have something else in it. And I could just look over the past 30 days and see that the components combined are spending a lot of time below 5. Well, it's not great. The demand is rising now, but it's not back to 5. The supply side, not bad at all. It's near 40%. So let's go in here and look at Tilray. Tilray is a 1, and it's been a 1. It's about 34% short versus 45% in the S&P 500. The lead behavior is high-speed traders, just machines like Citadel and Virtu, just trading it against other things. And so when should we buy Tilray? Look at this. This is a 30-day view, 30 trading days. And you want to see this green part of the graph above 5.
Notice a long ways to go.
Right, it's not. So it's just not great. Now, maybe if we come out of this options expirations period, so today, new options trade. Tomorrow, banks will true up the books. Wednesday are volatility expirations. Very important to know about that, because everybody will reset their volatility trades. That's both low volatility. I might say, I've got some JP Morgan funds through my financial advisors that are meant to track the S&P 500, but at 50% less volatility. Well, that involves derivatives that are designed to take out some of the volatility or offset it with some premiums, options premiums. So if that stuff picks up, maybe there's an opportunity in Tilray, but don't buy Tilray right now. I mean,
do you ever buy any stock with a market sentiment of 1?
Yeah, Netflix.
Netflix.
Netflix. Yeah, it's very interesting to see that if we could go back, test the data. And of course, historical data is no guarantee of future performance that is similar, but it's worth looking at. So if I buy Netflix at 1. I like 1 and 10 is really great with Netflix, usually. Now we'll see. Again, it depends. For me, this is really good. If Netflix is a 1 because it spends so little time there, if it goes to 1, you should buy it because it's almost never a 1. That means if you're trading it all the time, you're going to have a different entry point than a 1. But you could make 8% in 23 days. Now you say, well, that's not very much. Oh, yes, it is. It's very good. 29% holding at 90 days. You're doing better than that on a proportionate basis. So yes, there are the stocks that spend very little time at 1. Nvidia is another. Tesla is another. If those stocks are at 1, you could set up an alert to tell you when it's a 1 so that you buy it when it's a 1. And it's, that simple.
Tilray does not fit that bill.
Tilray does not fit. Tilray is just miserable. If we put Tilray in here and just back to why, you would say, well,
it trades on 1 all the time.
The 1 all the time. Exactly. It's really not more complicated than that. I mean, look at that. Buying Tilray when it's a 1 is almost as bad as just buying and holding it. It's down 49% the last 90 days. And why is that? Because look how much time it has spent below 5. So you want to find stuff that spends a lot of time above 5. Asana is, there's a stock that here's a stock that spends a lot of time above 5.
That was a Jason Raznick pick, by the way. We got to give Raz some props.
Okay, well, there you go.
Raz pick back at $22, I think, or $25. Raz, great call. I don't know if he still got it.
Choosing wisely. That's very good. Look at all that time above 10. I mean, and here was an awesome new entry point. If it drops below 5, okay, that's a great time to buy it. You would have made 20% in about 5 days on Asana. So it's, that's really supply and demand. And it will be interesting, Spencer, to see, back bringing it full circle, how having an ETF in cryptocurrencies, and ETFs are infinitely elastic. That's the difference between, ETFs are just going out and buying cryptocurrencies. They're going to use futures, right? And futures also are infinitely elastic. So you take an infinitely elastic vehicle called a futures contract, and you put it into an infinitely elastic vehicle called an exchange traded fund. And what I mean by that is ETFs can create as many shares as are necessary to accommodate demand and keep the price right in line with the futures contracts. Well, that's great on the way up. The trouble is always on the way down. And Dennis, here's something interesting to ponder. So I've been noting in my own trades that the likelihood that my trades are fragmented into fractions of pennies are 10 times higher on the way up than on the way down than the way up. So there'll be a penny spread in my trades on the way up. On the way down, it's a tenth of a penny, even a hundredth of a penny. I'll get intermediated. So that tells me something. It means it's very easy for money to get into the market. It's a lot harder for it to get out. And so those trades get fragmented.
That makes sense.
Yeah.
And there's a couple questions for Tim in the chat. Tim, I believe we've got you on the calendar on the Power Hour this Friday, I think. Okay. So we'll save those questions. Everyone tune into that.
Some power.
I just want to ask you one question here because
Yeah.
we talk about entries and using market structure edge. Take a look at Bank of America for me.
Yeah.
Because it's a screaming 10, right? It has to be a screaming 10.
Well, I don't know. Let's find out.
Oh, it's gotta
a
be
5.
Not
It's a 5.
necessarily.
It's at a 5?
Yeah, it's a 5, and it spends a lot of time at 5, which is interesting. What do you do with stocks that spend a lot of time at 5? Hold them during periods of market basing. So if Tesla stops rising, go to the 5s, like Costco. If you want to ride an options expirations period out, put your money in Costco.
Wow,
it's just a 5. Yeah. So, but that's the thing, Joel. It won't give you awesome performance. It's going to give you what the market does effectively. The market's about a 5.4 most of the time.
So you
right
wouldn't,
yeah.
So you hold this puppy, right? Until
Yeah.
it goes. What's the last time it's been a 10? Can you do that?
It was a 10 right here. So it was a 10 at the month-end transition. Now, why was that? Well, because the market was very volatile. Remember? So if we look at the broad market sentiment at the transition from September to October, look at it. We got clocked, right? So this was the market right there. Yeah, so everybody shoved their money into low volatility vehicles. And Bank of America is a great example. People like me using JP Morgan. Oh, the market's volatile. Put your money in the stuff that we will measure as 5s. Put it in Bank of America, Costco, Philip Morris, Procter & Gamble, stuff that's going to be 50% less volatile than the broad market. And that's where you want to be during volatility. As soon as the volatility's over, back to Tesla we go, and NVIDIA and so on. It's the way to think about the supply and demand of the marketplace and where the money's going to go.
Tim Quat is the founder of Market Structure Edge. Link is on the screen. Joins us every Monday, Tim.
He's got one more
Spencer,
thing.
I want to bring there. Here's the gravitas for this program, and it's got nothing to do with Market Structure Edge. You guys have been busy, but I want to note that Colin Powell passed away this morning, and I had a chance to hear him speak one time. I actually traded letters with him once. I can't even remember what it was about, but I want to acknowledge the passing of a very fine American at age 84 today, Colin Powell.
As you should. I saw that happened right at the top of our show, I believe. So as you should. Tim, thanks a lot. We'll talk to you again next week.